Good morning and welcome. I'm Kristen Strakalaitis with Automotive News. I'm joined by Erin Kerrigan, founder and managing director for Kerrigan Advisors. Erin, thanks so much for joining us today.
Thank you so much for having me.
Yeah, so with the auto industry getting back to normalcy, as we would like to think, what do you think will be the key forces driving the buy-sell market in 2023?
Well, keep in mind we're coming off of 2 years where we sold over 1,400 franchises. So it's been a very active market. But what's interesting to us is we don't see that activity slowing down at all in 2023. And that's largely driven by the fact that dealers are just making so much money and have made so much money over the last 3 years. We've had record profitability, and the average dealership was earning over $10 million in that 3-year period. And that's about triple the pre-pandemic average. So there's just a lot of capital in the marketplace, and those dealers are reinvesting that capital into buying the business they know and love, and that is auto dealerships. So we expect 23 will be another very active year, and that's certainly what we at our firm are seeing as well.
Now, Erin, what are the current macro and micro automotive retailing trends?
Well, there's lots of trends. There's lots of things going on in this dynamic industry. I would say the consolidation remains a major trend. And we surveyed in our Kerrigan dealer survey over 600 dealers and said, are you looking to expand? Are you looking to sell? About 50% are looking to expand. So we think that's a resounding commitment to the future of this industry in terms of the strength of future profitability. Certainly there are some headwinds, but we know that this is a very diversified business model that really succeeds in almost any economy. And so we expect that'll be the case again this year.
When you say headwinds, what are some headwinds that they could expect?
So interest rates are a major issue, certainly. But if you look historically, dealers have had a really consistent earnings level, even in high interest rate markets and low interest rate markets. But that is certainly on the top of mind of both dealers and consumers. You see the average affordability for a vehicle has really declined tremendously. And so that's something that certainly dealers are having to cope with. But again, they've always done that. We have had interest rate environments that have gone up and down, and through the thick and thin of those kind of economies, we've just found that dealers really have so many levers to pull on as it relates to their diversified business model, with fixed ops growing at 10% clip. That's the highest margin part of the business, and that is just on a tear. That will absorb any, in our view, of the challenges that you might see as it relates to some of the affordability issues that dealers are certainly working with their customers.
Erin, is there anything else you would like to tell our viewers to wrap things up?
Certainly. What I would just say is that, again, referring to that dealer survey, of the 600 plus dealers that we surveyed, 75% expect earnings to stay at 2022's level or increase in 2023. And 80% believe the value of their business will either stay the same, which is at record levels, or rise. So I would say that in all, the optimism in the industry remains very strong, and we expect 23 will probably outperform the headlines that some folks are seeing that are relatively negative. And if you look at, just to add, the Kerrigan Index, which is the index of the 7 publicly traded auto retailers, while it was down 33% in 2022, 23 it's started off incredibly strong. It's at 8%, and it's outperforming the S&P 500 by double the S&P 500's performance. We really think that's because Wall Street got a little negative on our industry, thinking we would be beat up pretty tough with the interest rate environment and the economy, and yet these companies are outperforming. They continue to hit record profits, and so we expect that the publics in our industry, based on what we're seeing, will probably do pretty darn well, and those stocks will rise.
Well, that's very encouraging to hear, considering what we've had in prior years.
Yes, it is. And the public's reduced their spending on acquisitions in 22. We'll see what happens in 23. But if their stocks continue to perform the way they have been, we may see more transactions from them.
Thank you, Erin. And thank you so much for joining us. Stay tuned for more NADA coverage throughout the week.